What's up guys, welcome back to another video. Today's video I wanted to run through the advanced bat formation. So again, if you go to my website, click on the patterns at the top here. It's got all of the patterns listed, advanced patterns right here at the top. So yeah, we'll run through this formation. So obviously again, we'll start this with the initial price swing. This initial price swing can be either bullish or bearish, up or down. For the purpose of this video, we'll do it initial price swing as bullish. This will obviously determine the resultant D point of the pattern, which will determine if we're looking for a bullish or bearish back pattern or what have you. So I have the X point here, an A point here. So this initial price swing is literally just that. It is just an initial price swing in the market. It's not determined by any Fibonacci ratios or retracements or anything like that. It is just an initial price swing in the market. It's just a significant move in the market. It tends to be quite clean, so there'll be some retracements, but no big retracements back and forth on the way up. It tends to be a nice clean move, higher or lower. So that's the X to the A point. The B point comes now as a 50% retracement of X to A and does not touch the 618 retracement of X to A. So draw that here. So we get our Fibonacci retracement tool, stretch it from the X point up to the A point, and as it said there, we get at least a 50% retracement of that X to A, and price does not touch the 618 level. So long as the candle wick exceeds 50% and does not touch the 618 level, then that is a valid B point. So the candle wick can exceed the 50% and retrace back up, and the candle close higher than that. So long as the wick's exceeded this level, price is valid. If the wick touches this 618 level or exceeds it, the price is no longer valid. So the pattern is invalidated. So we're looking for a B point to fall in between this red box here. So if I just label this up as our B point. The next point is obviously our C point. So I hope that was clear to you guys. Market forms C point if it touches at least a 382 retracement of the A to B leg and does not exceed A or 100%. So quite a broad fib retracement level here, so we can look for our C point to fall anywhere from our 382 level, which is this yellow line here, the 382 level, or 100%, or it cannot exceed that A point here. So again, so long as the wick exceeds 382, price can retrace back lower and close below 382 level. So long as that wick exceeds it. So we'll be pulling our C point to the price extreme here, so the highest price. So the wick exceeds 382, we'll be pulling it to the top of that wick. And obviously, if price moves higher here, the candle wick cannot exceed that A point. So even if it exceeds it and closes below it, that invalidates the pattern. So we're looking for a C point retracement anywhere within this red box here. So I'll put that here. I've just left that somewhere close to halfway. So our C point can form anywhere in that red box. And now finally, the market forms a D completion point by fulfilling an 886 retracement of the X to A leg. So again, get our fib retracement tool from X up to A. Pull this down a little bit more to get it closer. So from X to A, we're now looking at the D point completion at that 886 level, 886 of the X to A leg. Now this, again, conventionally, the limit orders are set at the D point. So let's just label this up here. Limit orders are set at the D point, and this D point acts as conventionally it acts as a reversal zone. So we're looking for price to bounce off of this level and continue in the same direction as the initial price swing from X to A. So looking at price to bounce off of this level for advanced patterns, Conventionally, you set limit orders at this level, and then stops below that and targets above it once the price bounces off of this level. So if I just draw all this up quickly, X to A to B, C, D. So that is our bat pattern with the limit orders set at this price here, and you're expecting price bounce off of this level and move higher. So as for stops go at the 113 extension of XA. So instead of our retracement tool now, we get our extension tool from X up to A, and it's the 113, so just enable 113 here. So 113 is our stop loss level. So our stop losses go at the 113, so if price if this pattern gets invalidated, price moves lower and lower and lower and lower. As soon as price hits this 113 level, we have our stop loss here, and we are cut out of that trade at a small loss. Our take profits are at the 382 retracement of the A to D leg, and our second take profit at the 618 retracement of that A to D leg. So again, get our retracement tool, and we're going from A, and instead of the X to A or A to B or whatever, we're going from the A point all the way down to our completion point. And our profit targets are going to be at the 382 and the 618. So these are our two. That's a bit with there. These are our two profit targets here. So we're looking at profit 1 when price retraces off of this level and hits our 382 level here. That's our target 1, and our target 2 are going to be the 618. Now, if price continues to move lower before it retraces higher, because remember this is just our limit order set at this point. However, these points shouldn't be treated as exact prices where we're expecting price to bounce off of. We are expecting some room for movement, which is why we've got this zone here between our limit order and our stop loss, because we're expecting to, or we've left this room for price to fluctuate before it reverses, which is why our stop loss is down here. So if price does move lower, so say we get a wick to the downside here, then conventionally you should extend your fib retracement tool down to the price extreme and alter your targets alongside that. So the lower it goes, the lower your targets will be. This obviously does affect your risk to reward, because you've got up here initially the targets would be, so we've got a 22 pip stop loss, 30 pip target 1, 50 pip target 2. So we're greater than a 1-to-1 risk reward, and we're greater than a 2-to-1 risk reward for target 2. Now obviously if we stretch our fibs lower, we're then lowering that risk to reward ratio. So we've now obviously got that 22 pips stop loss. We've now got a lower than a 1-to-1 risk reward for target 1, and just under a 2-to-1 risk reward for target 2. So that obviously does lower that, but the retracements need to be from the price extreme. So A is our price extreme to the upside, and D, obviously if price moves lower, we need to stretch our fib levels along with the price to the new price extreme. Hope that makes sense. Now, all going well, if none of that happens, and we'll probably get a bit of an extension to the downside, but if our first target is hit, so our 382 target is hit, conventionally the rules state that you should move your stop loss level to break even, so to the limit order point where you got in at this, so that if price moves higher, hits your target 1, and then begins to retrace, you have already taken profits at this level, so you've already you're in profit, and you've secured those profits by exiting the market, or exiting half of your position, because you've got 2 targets here. Exit half your position when the first target's hit. Move your stops to break even, so that if price retraces, you are not going to lose any money on this trade. You've secured your first profits, and you've the maximum loss you can take now, it's, well, nothing. You've moved your stop loss to break even, so it's 0. So you'll be stopped out here at 0. Obviously, if price continues in your direction, it's a risk-free trade, because you're not risking anything now to make it was a 2-to-1 risk reward, or over 2-to-1 risk reward, until you hit your second targets here. Now, it's worth mentioning you should backtest this yourself. The stop loss levels might need altering for whether you prefer higher win rates or lower win rates, but better risk to reward ratios. Whatever you prefer, or whatever's more profitable, should be said. And obviously, you moving this stop loss might not be beneficial to you. You should test it with and without moving the stop loss level to see which performs better. You're more likely to win more often if you don't move the stop loss level. However, losing that at break even more often might be more profitable than taking a loss after hitting your first target. But yeah, see what happens. It's better you testing that yourself and figuring out which works best for you. Again, it's better you testing it on all the different pairs, because none of the 2 pairs are the same. They all act differently, all got their own personalities, so test them on each different pair and different time frames as well. Each pattern and strategy should not be copied and pasted onto different time frames and onto different pairs. They'll all act differently, so it's important to test that. So again, that's the bat pattern. I hope this has been of value to you again. Thanks for watching. Hope to see you soon. Cheers. Ta-da.